All right, if you're a small business owner, you know this feeling, right? You're trying to save every single dollar you can on taxes. But you also know that down the road, you might need a loan to really grow. Today, we're going to talk about how to walk that very, very fine line.
Yeah, of course it does. It's basically the entrepreneur's creed. Minimizing what you owe the taxman is just plain smart business. It frees up cash, and not cash is the fuel for your hustle. And look, you're not alone in thinking this way, but as we're about to find out, it can have some unintended consequences.
Okay, let's get right into it. So first, how are savvy business owners actually lowering their tax bill? The smartest strategies aren't some secret, complicated trick. They're really just about being consistent and, of course, legal.
So you start by claiming every single eligible expense you can think of. Your rent, supplies, all that marketing spend. Then you start layering on the really powerful deductions, like the home office deduction. And hey, if your business is what's called a pass-through entity, and most LLCs or S-corps are, the qualified business income deduction can literally chop your taxable income by up to 20%. Even things like maxing out your retirement plans helps cut your taxes today while you're saving for the future. The goal is super simple. Get that taxable income down and keep more cash in your pocket.
And here's the twist. You've done an amazing job. You've masterfully shrunk your taxable income. Your tax bill's nice and low, but now you need cash. You need capital to expand, to bring on new people, to buy that shiny new piece of equipment. So, what happens then?
This right here is the heart of the problem. Your goal is to show the absolute lowest profit possible to the IRS. But a lender, they want to see the exact opposite. They need to see a nice, healthy, consistent profit so they can feel good about you paying them back. You're basically telling two completely different stories with the exact same document.
So let's do this. Let's put ourselves in the lender's shoes for a minute. When that loan officer gets your tax return, what are they actually looking for? What's making them lean towards a yes versus a hard no?
This is such a critical idea to get your head around. You have to stop thinking about your tax return as just some boring compliance paperwork for the government. It's actually one of the most important marketing tools you have for your business's financial health. It tells a story, and you need to be the one controlling the narrative.
So what's the story they want to read? Well, they're scanning for consistent profit, because profit is what creates cash flow, and cash flow is what pays back loans. Simple as that. Now, yeah, they might add back certain big deductions like depreciation, but most of your other clever write-offs just make your income look dangerously low to them. Oh, and unpaid taxes? That's almost always an automatic no. And showing losses year after year? That's a massive red flag.
But you know what? It's not just about the numbers on the page. The actual structure of your business, how you legally set it up, sends a really powerful signal to lenders about how you handle risk and think about the future.
Think about it. A sole proprietorship is super easy to start, but to a lender, it kind of shows that your personal and business finances are all tangled up together. An LLC, though, that's a huge step up. That legal barrier doesn't just protect your house and your car. It tells a bank that you treat your business like a serious, separate thing. A C-Corp has its own pros and cons, but again, every one of these choices tells a story about your long-term vision and how financially savvy you are.
And speaking of costs, this is a perfect example. If you're in a state like California, just choosing to have the protection and flexibility of an LLC or corporation comes with this fixed $800 annual franchise tax. It's a trade-off, right? A yearly cost in exchange for protecting your assets and having way better options for tax planning.
So you have all these little trade-offs, like paying an annual fee to get that liability protection. And this brings us right to the main idea for how to handle this whole situation. It's not about choosing tax savings or getting a loan. It's about mastering the art of balancing them both.
I want you to think of your entire financial strategy like a teeter-totter. Your job is to keep either side from slamming into the ground.
So on one side of the teeter-totter, you've got everything that pushes your tax bill down. You're maximizing every deduction you can, you're aggressively writing off expenses, and the result is showing a lower net profit on paper.
And on the other side, you have everything that makes you look like a fantastic investment for a lender. You're showing consistent profit, you're proving you have healthy cash flow, and you're presenting a financial picture that just screams low risk. The real art is finding that perfect balance point in the middle.
So the solution is this really important concept called strategic profitability. What it means is you stop trying to get your profit down to zero. Instead, you aim for a healthy, credible bottom line. Now, healthy isn't some magic number. It just means showing a positive, steady trend. A lender would much rather see you make a modest, growing profit for 2 years in a row than see a huge profit one year and a big loss the next. And yeah, this might mean you intentionally put off some expenses to make this year's profit look better. You might pay a little more in tax this year, but what you gain is access to the capital that's going to let you grow your business tenfold.
Okay, so that's the big idea. But let's move from theory to practice. How do we turn this into a real, concrete game plan that you can actually use for your business?
Here it is, a simple 4-step checklist. Number 1, aim for that strategic, moderate profit we just talked about. Number 2, make absolutely sure all your taxes are paid and you are current. No exceptions on that one. 3, be ready to explain your numbers. Have a story ready that shows a lender you've got a clear plan for their money. And 4, and this is a big one, talk to your CPA about your growth plans early on, not just a week before taxes are due.
And this right here really sums up the payoff. A smart tax strategy gives you savings, sure, but showing the right amount of profit on paper, that gives you something way more valuable: leverage. The leverage to get the funding you need, on your terms, right when you need it the most.
So I'll leave you with this question to think about. Is your tax return just some annual chore you have to get done for the IRS, or is it a strategic document that you are actively using to build the future of your business? The choice and the power is all yours.